Hello and welcome to our market alert video for today, which is December 9, 2022. And we got some data on inflation, which may give us some inkling about where inflation is going to be when the big number, the CPI, the Consumer Price Index, comes out next week. And then the Fed will tell us what they're going to do with interest rates and how they see everything playing out. So we got a little bit of an advance notice, although it's not a direct correlation. It gives us some inkling. So I'm going to dive into all of that. But first, I want to wish you all the best. I hope the holiday season is upon you, that you and your family are all healthy, wealthy, and wise, and that you are enjoying all that this season brings. It's my favorite time of the year, I have to admit. So let's dive in. The PPI, the Producer Price Index, came out this morning. And it came out hotter than expected on a month-to-month change. However, the way that inflation is calculated is that it is year on year. So in other words, they drop last November off and they add this November on. So if the inflation rate last November was higher than the inflation rate month to month this year, then when you drop that off, inflation goes down. But what you have to look at is what is the difference between October and November of this year. So you got two different things, and it can get confusing, but you could actually have the inflation rate go down, the headline number, but the month to month go up, in which case that's actually bad news. So we'll have to wait till next week to figure all this out and see what the Federal Reserve's reaction to it all is going to be. Now, as I've mentioned in previous videos, what the Federal Reserve is trying to do is not to avoid a recession. They're trying to get inflation down, and if in the process they avoid a recession, so be it. But they're not looking to avoid a recession, they're looking to get inflation down. And again, we described to you in previous videos that what the Fed is trying to do is they're trying to get an equilibrium between inflation and interest rates. Right now, inflation's up here and their interest rates are down here. So they're hoping that as they raise interest rates, inflation comes down and they meet. And right now, what the market has been saying is that by next May, those two would meet at about 5%. Now, if that happens, then 5% is not going to destroy the economy, cause massive unemployment, cause the stock market to crash. It'll be a shallow recession, and the Fed will have engineered what they're calling a soft landing. However, right now, because the PPI number came in hot, there's talk that maybe they'll have to raise interest rates to 5.5%, maybe 6%. Ray Dalio, who runs one of the biggest hedge funds in the world, Bridgewater, said that it could go to 6.5%. And if that happens, that's Armageddon. So we'll have to wait and see where all of this takes us. But certainly, the higher interest rates go to reach that equilibrium point, the worse the recession will be. And if the recession is very bad, then of course the stock market will reflect that in our view. So where do we think this is all taking us? The truth is, we don't know. It's a 50-50 proposition right now in our view. And so because of that, we think it's better safe than sorry. We're still in cash, money market fund. And the Fed, one of the things I said, I was interviewed on TV, and they said, well, why are you sitting in cash in the money market fund? And I said, because I don't want to fight the Fed. Fighting the Fed has been a losing proposition for 20 years now. So why would I want to do that? And so if they are insistent on driving down growth, raising interest rates to kill inflation, then why would I want to be into things that are hurt by that, i.e. stocks and bonds? Why would I want to do that? How about if I'm in the thing that the Fed is helping, which is the money market fund, because as they raise interest rates, guess what happens? The interest rate in the money market fund goes up. And if we're sitting there and we're nice and safe and we're getting a higher interest rate while we're waiting for the storm to pass, what's wrong with that? So in our view, you don't fight the Fed. And it's a dangerous proposition if you do. So if you're still invested right now, you may have noticed that both your stocks and your bonds are down for this year. Diversification in some years does not work very well, and this is certainly one of them in our view. So get a second opinion, talk with one of our retirement planners. Our website again is rpoa.com. We're happy to visit with you, no charge or obligation. If we can help you, fantastic. And if not, that's fine too. We'll part friends either way. So share this video with as many people as you'd like, and we'll look forward to hopefully getting to meet you at some point. But in the meantime, I hope you enjoy the holidays with your family and your friends, and I hope that all is well with you. Thanks for watching this video, and we'll talk soon.